Welcome to another episode of Real Financial Success. This is your host, Chris Gunnels, and this is where I teach you what I'm doing to gain financial independence. Before I explain what my favorite strategy is, let me explain what an option is. First, when you buy a put option, you want the stock to go down. And when you sell a put option, you want the stock to either stay the same or to go up. And in the inverse of that, when you buy a call option, you want the stock to go up. But when you sell a call option, you want the stock to either stay the same or go down. Another important note is to know that each option has an expiration time, meaning that they are only good for a certain number of days. They have weekly options as well, but I primarily sell the monthly options, which expire on the third Friday of the month. Now that we know a little more about options, let me explain what my favorite strategy is. It's to simply sell naked put options. And I like this option strategy because it allows me to make monthly cash flow on a stock that I want to purchase anyway. I'm just trying to buy it at a deep discount. How I make monthly cash flow is by selling these put options and gaining a premium for doing so. Basically, I'm taking on risk to buy the stock if it goes down at a certain price. And because of that risk that I'm taking on, somebody's willing to pay me money to take that risk. And another reason why it's my favorite strategy is because I'm actually making more selling premium on these put options than owning the stock and gaining the dividend. Also, another great reason is because I'm actually paid monthly instead of quarterly. If you don't know this, most stocks that you own, they only have a quarterly dividend as opposed to a monthly dividend. There are some stocks that do have monthly dividends, but it's really small, like maybe 5 cents or 10 cents or something like that. I'm trying to get the dividend amount every single month. Also, another reason why this is my favorite strategy is because I get a better ROI than if I owned the stock and just collected the dividend. Right now, I'm getting about 10 to 20% every month. And the reason why is because I'm using margin. And I have an example later on in the episode for Exxon Mobile that I'll go over on why I use the margin and how I'm getting that 10 to 20%. Now, of course, a very important note here is that I only do this on stocks that I actually want to buy because they have, a healthy dividend yield of 4+%. I don't do this on stocks that have a low dividend yield, less than 3.5% or so. Or I don't even do it on stocks. I don't even consider stocks that have no dividend at all. I mean, seriously, who wants to speculate and own stocks that may go up? You outlay money to buy the shares of stock, but you're not getting rewarded unless the stock goes way up. So, for example, let's say you get lucky. Let's say you bought Tesla in 2018 or 2019 for a couple $100. And this year you got lucky because it boomed over $1,000 per share. That does happen, but it rarely happens. So I would prefer to gain a dividend or monthly premium for selling options as opposed to getting lucky. Now, let's get into the pitfalls of this strategy, if there are any. Honestly, for me, there's really only one, and that this one rarely, if ever, happens. And that is simply if the underlying stock goes to $0 per share, I would lose my entire investment. But the way that I look at this is, let's say I bought the stock anyway, before selling the put option, I would still have lost my entire investment if the underlying goes to zero. So, for example, let's say I bought a stock for $40 per share today, and in a year it goes to zero. yes, I lost that $40 per share. But let me give you another example. Let's say I sold a put option for 30 days out. That was for the $35 strike price. And let's say the underlying went to $33, and at expiration, I was put the stock. So I had to buy the stock at $35 per share. And let's say in a year, the stock goes down to zero, just as before. Well, yes, I would lose that entire $35 per share, but it's better than losing $40 per share. I saved $5 per share, if that makes sense. Plus the actual option premium that I gained, which is usually about $1. I aim for about $1 or more on a 40, $35, $40 stock. Of course, some would say another pitfall is that I'd be put that stock, like I was saying, or in other words, I'd have to buy the stock at the strike price I sold it for. While that is true, you need to remember that you were going to buy this stock 30 days ago at a much higher price. So owning the stock isn't really that bad. You now get the dividend, you get voting rights. I mean, if you care about that sort of thing. And you can sell the calls against your stock for even more monthly cash flow. That'll be in another episode. I'll try and make another episode on selling calls against your stock for more monthly cash flow. So stay tuned for that. Okay, let's move on to my example on Exxon Mobile. On December 21st, this year, 2020, I sold the February 19th, 2021 37.5 put option. Now, yes, this is more than 30 days. It's 60 days, but I sold it for $1.35. And at the time, the underlying Exxon Mobil was trading around $42.50, I believe. So what I have going on is if Exxon Mobil drops down to 37.5 or below, at expiration February 19th, 2021, I would be put the stock, meaning I have to buy the stock at $37.5. But that's not a big deal. I want to buy the stock right now, which is sitting at $41.75 at the time of this recording. And the actual underlying has a dividend yield of, it's 10%, 10.13% is the current dividend yield. And that's amazing. So even if I bought the stock now, it would be an awesome dividend buy. And in my opinion, I think eventually oil prices will go back up. And this is a safe stock. It's been around for a very long time. It's a dividend aristocrat. So since I sold this put option for $1.35, the 37.5 put option, I gained that $1.35 per share. And if you don't know this, each contract that you sell in options is worth 100 shares. So it's $1.35 per share times 100. So basically $135. And I'm using TD Ameritrade, and they charge around, or they require, I guess you could say, around 20% of the actual underlying to sell an option. And so right now, my buying power effect is $534. What that means is that they took $534 out of my account to cover this position at the time being. And because it was only $500 that they took out of my account, that's how much money I'm outlaying for this position. And because I got $1.35 per share, or essentially $135, if you do the math there, what is that math? $535 or whatever divided by 135, that works out to be about 25% ROI in 60 days. And that, of course, is if the stock stays above $37.50, we'll let it expire worthless. And I keep that full $135. Now, if it goes below, obviously I have to buy the stock, or I can roll this position out. If I want to be defensive, I can roll this out to the next expiration, or just take the stock and gain the dividend, right? That's up to you and what you want to do. For me, I haven't quite made that decision. Honestly, it's at a good price at $37.50. I think I would actually probably buy the stock and just hold it, gaining the dividends and also selling calls against the stock. If you're listening on the podcast, make sure you head over to my YouTube channel so you can get an actual visual representation of what I'm talking about on each of these episodes. And if you're watching this on YouTube, please make sure to hit that like button, subscribe, and to share this on your Facebook, on Twitter, on any of your social platforms. That would be very helpful to me. It also encourages me to keep spending my time to create these videos and to hopefully teach you and help you also become profitable in the market. Also, it helps YouTube's algorithm. Basically, it lets them know that what we're doing here is valuable to you and it could potentially be valuable to others. All right, guys, that's it from me today. I appreciate you guys watching and listening. I hope you have a good one. Love you. See you next time. Bye.